Let's explore the differences between the S&P 500, Dow Jones Industrial Average, Dow 30, and NASDAQ. Composition. S&P 500. The S&P 500, short for Standard & Poor's 500, is a stock market index that tracks the performance of the 500 largest publicly traded companies in the United States. These companies are selected based on factors like market capitalization, liquidity, and industry representation. The S&P 500 aims to provide a broad representation of the U.S. stock market. Dow Jones Industrial Average, Dow 30. The Dow 30 is an index that consists of 30 large, publicly traded companies from various industries. It was one of the first stock market indexes created by Charles Dow and Edward Jones. The Dow 30 is not as comprehensive as the S&P 500 and includes only a small number of companies relative to the broader market. NASDAQ. The NASDAQ Composite is a stock market index that includes all the companies listed on the NASDAQ Stock Exchange, which is known for its focus on technology and growth-oriented firms. The NASDAQ Composite represents a wide range of companies, including technology, biotechnology, telecommunications, and more. Methodology. S&P 500. The S&P 500 is a market cap-weighted index, which means the weight of each company in the index is based on its market capitalization, the total value of outstanding shares. The larger the company's market cap, the greater its influence on the index's performance. Dow Jones Industrial Average, Dow 30. Unlike the S&P 500, the Dow 30 is a price-weighted index. The index is calculated by adding up the stock prices of its 30 constituent companies and then dividing the total by a divisor to generate the index level. The divisor accounts for stock splits, dividends, and other adjustments. NASDAQ. Similar to the S&P 500, the NASDAQ Composite is also market cap-weighted. The weights of individual companies are determined by their respective market capitalizations. Representation. S&P 500, due to its larger number of companies and broad sector representation, the S&P 500 is considered a more accurate gauge of the overall U.S. stock market performance. Dow Jones Industrial Average, Dow 30. The Dow 30 is composed of 30 blue-chip companies, and it is often seen as an indicator of the health of the U.S. economy. However, its limited number of companies can lead to a skewed representation of the broader market. NASDAQ. The NASDAQ Composite is associated with technology and growth companies. It is often seen as a benchmark for the performance of technology-driven industries. Performance and volatility. S&P 500, due to its diversification across 500 companies, the S&P 500 tends to be less volatile than the other two indexes. It provides a more stable and balanced long-term investment performance. Dow Jones Industrial Average, Dow 30. With only 30 companies, the Dow 30 can be more susceptible to the performance of a few influential companies. As a result, it may experience higher volatility compared to the S&P 500. NASDAQ. The NASDAQ Composite's focus on technology and growth companies can make it more volatile, especially during market fluctuations related to the technology sector. In summary, the S&P 500, Dow Jones Industrial Average, Dow 30, and NASDAQ are three popular stock market indexes, each with its own unique composition, methodology, and representation. The S&P 500 is broader and more diversified, the Dow 30 is smaller and price-weighted, and the NASDAQ is tech-oriented and market cap-weighted. Each index serves as a valuable tool for investors to gauge the performance of different segments of the U.S. stock market.